May I now ask the value investing professionals to prepare for the Q&A. I just want to ask, I guess, all of you, what do you make of the ESG craze and that everybody's trying to develop an ESG product? Is it like marketing thing or is it real? Is there evidence that ESG does well, performs well versus other ways of carrying out business?
Well, I think it is. It is clearly a very important trend, and it's a very important trend in markets and in fundamentals in terms of businesses. As to ESG products, I think they are extremely difficult. I mean, I don't want to run down anybody else's ESG product, but ESG really is now embedded in investment managers' processes. It has to be. And if you have an ESG product, it does slightly raise a question about what your other things that you're doing are. Are they not ESG? So I think it has to be embedded. And if you follow some kind of automatic process, it has all sorts of difficulties. I mean, for example, Royal Dutch Shell is probably the largest investor in renewables in the world. To exclude a fossil fuel company like Royal Dutch Shell seems to me very paradoxical when it may be the leading originator of renewable forms of energy. So I think it's complicated. And I also think there's room for an awful lot of hypocrisy. You and I and most people on this thing probably travel on EasyJet. I think it's rather hypocritical to ban airlines, for example, which are great consumers, obviously, of energy, and continue to travel on them ourselves. So I think it's a very complex field. And the MSCI and other measures of ESG quality are still flawed. I'm sure that investors on this call will all have seen examples of this. I can't think of any offhand, in fact, but there are some extraordinary sort of contradictory results. I've always quoted a businessman who said that if you don't keep the score, you're just practicing. The trouble is, we're not quite sure what the game is that we're playing at the moment. Is it squash or is it tennis? But all the same, I think it is good to keep the score, and we'll find out in due course what game it is we're playing, and to ensure that ESG is part of the process which is explained to clients.
Like, has anybody done any numbers, I guess, comparing ESG performance historically versus other means of...
Yeah, they have. And ESG in the recent past has performed extremely well, which is no surprise given what's been going on in the world.
Goran, what...
Yes, from a purely performance perspective, we have run for institutional clients ESG portfolios for almost 10 years now. And we have downloaded multiple ESG vendors, historic data as much as we can get. And I think we have roughly analyzed 250 plus variables which are in the ESG family. And the data is the data, first of all, the coverage is not good. The history is too short to say it works or it doesn't. Matter of fact, is what Richard said. I think there's periods where it's self-fulfilling prophecy. So if everyone is looking at good ESG companies, then they will do good because they're currently good theme. On a standalone basis, ESG, I think, is to tell you that the stock, because it is good or bad ESG, obviously, all different vendors disagree on what is the right ESG formula. So you don't even know what is the right ESG. So it's very specific and subjective. But on a standalone basis, we believe without looking at valuation, you can't say it's a good investment purely based on ESG. However, everyone should look at parts of ESG, especially when it comes to governance, in our opinion, because if your board is not diversified or parts of the community, such as females in parts of Asia, are not allowed to be in management positions, obviously for the business, that's not good. And obviously a business that allows it has a competitive advantage. So we think from a purely performance enhancing perspective, the governance, there's some good things being done. But saying that ESG on a standalone basis outperforms, there's not enough data that supports that at this point in time, in our opinion.
Okay, Christina, have any chat questions?
Yes, we have one question for Mr. Paramés from Julio Utrera. Mr. Julio Utrera, what type of analysis have you undertaken for the oil drilling sector to gain comfort? There is no risk today of 1920s, buying cheap horses just before the advent of the automobile risk.
Well, when I see what is going on in Norway, I don't see that risk. And I see this, as someone mentioned, that even in 2030, 85% of the cars will be combustion engines. So, I mean, I should advise anyone that has doubt on oil consumption in the next 15 years to travel a little bit all over the world and ask people what do they want. And most, I mean, the 4 billion people in the world, perhaps 5 billion people in the world that don't have still the bare necessities covered, the first thing they want is to have a safe electricity, safe heating, and you know, the basics things. And unfortunately, we don't see anything else in the future that can substitute the fossil fuels in all of those countries. I mean, they're hoping to have some gas. They're hoping to heat their homes. They're hoping to have the surgical theaters able to perform all day long and not every two hours, depending on whether the sun is shining or not, because some of the surgery theaters are fueled by solar energy that is not stable, as we all know. I mean, it depends on the sun shining or not. So I would ask if anyone has doubt to travel a little bit. I've been treated for 3 days in Ghana this week. I was just reading what is going on in India to ask the people that really need it, what do they think about the oil future?
Any questions?
We have one question in the chat section. Okay. For everyone, would you say that Europe vs US markets is similar to value vs growth investing?
I guess because in the US you've got many more technology stocks than in Europe. The question is, if you compare Europe and the US, it's like Europe is the value and US the growth. I know you are the eldest statesman in the group, and you want to jump in, Richard? Go ahead.
Well, broadly speaking, I would say yes is the answer.
Okay, and I mean, it seems that in the US, if you look at intangibles as a percentage of tangible assets, have grown really. I've seen the numbers, like, have grown like humongous numbers. So I don't know in Europe where there's a comparison of intangible to tangible assets.
Well, I think that
George, may I comment something, because I think I understand that being a Greek, maybe understand the question. Sorry to interrupt, Mr. Oldfield. I think the question is if value in Europe will be outperform or globally will outperform is the same as the US, because basically when most of us analyze, most investors analyze value versus growth, they get a US approach about value versus growth investing, and we don't see the microcosmos, like what about the European market value versus growth, what about Asia? I think it was, I saw this very interesting graph in recent research affiliates paper, which said, did I miss the value turn? And in there they have what is the expected return of various strategies in the next 10 years. And interestingly enough, they expect that value in EU, in emerging market, UK and Japan value, that's the value strategies. I guess this is naive, as you said at your initial presentation. They're going to outperformed by more than 6% over the other markets, real returns that is. And I think this maybe answers the question that even in EU, the value will outperform other forms of growth or, index investing.
There's a question in the chat here. You going to read, Christina, or are you going to read it?
Yes, of course. From Mr. Domenico Fanelli for Mr. Jiménez or Mr. Alvarez. I appreciate revenues and EBITDA are growing, but what do we know about the capital invested necessary to generate these revenues and EBITDA? What median ROIC do you foresee? How can we even measure capital invested as assets like football players are very hard to value?
Mm-hmm. Can you hear me well?
Yes.
Okay, so I will get that one as Jose Luis is also on a flight right now. So that's quite a good question. So the thing is that we are at the beginning of a process, so kind of difficult to measure ROIC and right now to where it should be in some years. You can do these kind of comparisons that we did in the presentation between the US sport franchises and European markets, but capital is right now much more expensive in European markets, which is probably not going to be the case in the coming years. And in order to say that, maybe one good example is the current of the recent CVC and La Liga deal. I don't know whether you are familiar with that, but many clubs in La Liga are receiving a loan from CVC, and this is a 40-year loan at zero interest rate. So they are now starting to have the capital to make the investments, and that investment will produce higher ROIC in the future. So looking at the ROIC right now, in general, I think it's not a good option. Maybe looking at the ROIC at some clubs is interested. I mentioned that investment that Olympique Lyonnais made in the stadium just 4 years ago. Let me remind you the numbers. So they invested 400 million euros in a new stadium. Prior to COVID, they were getting 50 million euros revenues, and that was half from match day, let's say, revenues, and another half from company workshops, events, rugby games, concerts, and all that. So this is the kind of numbers that we have right now to evaluate the profitability of the investments, and then you have to go more at the micro level because the story is not happening now, but probably going to happen in the next 2 or 3 years. And the other thing that the question was mentioning was how about valuing football players, and this is true. This is kind of difficult. Obviously, now you have more and more tools, analytics, or even some providers on valuation of players. But I think that just looking at the value of the players is maybe an alternative valuation, but is not the kind of valuation that we usually do. I mean, we usually look at let's say the fundamentals, the number, the profits, and on top of that, you can look at the valuation. And for example, and I was mentioning Olympique Lyon in France with this 400 million euros stadium, current enterprise value is close to 400 million euros. So actually the players, you are getting them for free.
Now with the advancement, I guess, of telecommunications and with the middle class, I guess, around the world becoming, I guess, richer, the football has become more of a global audience game, right?
Exactly. Now with the technology, you can have someone in the underground in Singapore watching a game at a very low cost. So it's becoming even more global. If you look at the number of social media followers of some of the football players, they are far more than any player in any other sport. So yeah, I mean, football is becoming global, and as I saw in the chart in the presentation, the distance is still from the TV rights of European football compared to NFL, NBA. Obviously, they are in a much bigger market like the US, but some of these leagues are more local. Obviously, in a local market that is huge, but more local than football, which is a more global product and will benefit from technology and the growth of media.
Okay, thank you, Luis. Now, Thomas, is there like evidence that whenever Turkey is raising the pressure, I guess, this affects the stock market in in Greece?
No, I don't think it's at some point you could see some evidence, but I don't think I don't know any studies to be that have been done like that. But no, I don't think it's on the radar of the screen of the investors right now. I think the last decade was mostly about the economic events and the political events in Europe that really affected the stock market. And especially, you could see every month that Troika was here. We had a lot of volatility of what they said on in that ministry and this ministry. We had more volatility from that than from Turkey, I think. But now, not even that.
Okay, David, I see you have your hand up.
Yes, I'm gonna try again.
Okay, go ahead.
So I have a question for both you and Mr. Paramés. I'd like to have your opinions about what's happening in China. So do you consider it an investable country for investors right now? And in your opinion, is China going to cripple its champions by demolishing most of their moats in order to serve their common prosperity goal?
So that's for Francesco, but anybody, I guess, can jump into this question. So Francesco, you want to?
Well, okay, I follow it from the press because it's a long time since I don't go there. But the authorities are trading a fine balance between intervening in the economy and letting the private sector work. So it's a fine balance that, as usual, is not easy to play. But I mean, they have done very well in the last 40 years doing that. And when they push too hard, they pull a little bit and again continuously. So I would expect the bureaucracy, I mean the authorities, to keep on doing that. I mean it is true that it's a part of the economy that, I mean, the line has always been the same. Is if you do business in a private economy in the sectors that are not really regulated or the sectors that are not relevant for the Communist Party, for the authorities, you are fine. If you are in the restaurant business, if you are in the bakery business, in the typical sectors, you are fine. If you are in strategic sectors, you have the government involved. But I have to say that this is the same thing in Spain. I mean, they just intervened in the electricity market last week in a big way, and they are doing that again in France and anywhere. So in the strategic sectors, I don't think there is much of a difference between what's going on there and in any other developed countries. And then we have this late intervention in the internet area and gaming and all that. Well, we are not investors in China, so we are just indirectly investing in China. So what can I say? I mean, hopefully you don't get burned in an investment in your sector. But I think that after that, one of the ministers stressed that private investment is welcome, and they're really keen on getting technology and getting investments, and the normal sectors let them work. So what is going now with energy? It tells you that the economy is really doing well. I mean, the consumption is increasing and the business is quite booming, and actually they are run out of energy. So this is a good sign that things are really working well. I mean, I've been always positive on China, and I wouldn't bet against the bureaucracy and the authorities trading this fine line between pushing too hard or not.
Any other question have from the chat, Christina? No?
Yes, we have one now from Mr. Ignatiadis. This is a question for all the speakers. Do you think that artificial intelligence may render the human stock picking skills redundant in the next decades?
Yeah, well, I believe that investing is much of a science as it is an art, and as we are very data driven, and we follow a lot of investors that do machine learning and AI. and we found that they don't work extremely well thus far. I don't think that machines can learn to have a philosophy or have a human, the art aspect. I think the science, computers are smarter than we are. There's no question about it. The more scientific it gets, the better the computer is than a human. But to extrapolate or take advantage of the human misbehavior, irrational behavior, to teach a computer to do that, time will tell. I don't think that the computers will do it completely alone. I think computers should be there and should help us to do the analysis and to help us maybe stay in line and to check our thinking. But completely alone, it's potentially going to be very difficult. And I think one good example for anyone who's dealing with this, thinking about machine learning or AI, we took a look at three-way chess. I'm not sure if you're familiar with it, but for a long time, Kasparov, famous chess player, basically created this tournament of chess players that play against each other using computers. And interesting enough, a computer on its own obviously is better than a human chess player, but the human with the computer is better than a computer alone, which is quite interesting because there's some basic human judgment. And a very good player with a computer is not as good as the average player with a computer because a very good player overrides the computer too often. So we really like this combination of man and machine, but time will tell.
Richard?
Sorry.
Yeah, then Thomas. Richard?
Yeah.
I think that, first one has to recognize that active investing is a zero-sum game in the sense that since active investors compose the market for any reasonably developed market, since they compose the market, there will be as many investors who underperform as outperform over any period. And so AI may well be part of that equation, in which case I think it's perfectly conceivable that you have as many AI machines which are outperforming as you have AI machines which are underperforming. And I rather doubt, like Goran, I'm pretty doubtful that will be that AI will anytime soon really be able to show any kind of superiority over humans. Long-term capital management was pretty much an AI type of program, and programs which depend on measuring volatility over certain years and the relationship of different stocks and so on, and correlations, and also more sophisticated, more recent forms which measure sentiment in particular ways through mentions in the press and mentions on email and so forth. All of those, they're still flawed because I think they're poor at the Minsky moment. They're poor in dealing with the continuation for quite some time of a trend and then the very abrupt change in the trend. And they're poor at dealing with the Minsky point, that if you have stability for a long time, it makes instability more likely. So I don't think it will be anytime soon. My measure of this for about 20 years, I've always said, as long as it's more difficult for a robot to cross the concourse of Victoria Station during the rush hour, then an AI machine will not be able to substitute for humans, because humans do all these tremendously subtle thousands of judgments about where somebody's elbow is, where their eyes are looking, what speed they're going, whether they've already got a tendency to change direction, all these things which enable one to cross the concourse of Victoria Station without bumping into people. So I think the answer is not for some many years to come, but I don't know, of course. And an AI machine does know.
Thomas?
I think it's difficult, the machines to substitute humans. If this ever happens, we're going to have zero returns because we're going to have the perfect market. As I agree with Richard, half will outperform, half will perform well. So artificial intelligence will make zero returns, but the market exists, as you said, and that's why I wanted to hear your opinion on that. Exists because of the human nature, because humans are afraid. And I think, Richard, what you said about the Minsky moment and where the artificial intelligence and the machines might lose it. We saw that last year when I believe, from what I read in the crisis of the pandemic, it was the program trading and the programs that really pushed the markets into very low levels because they were not programmed to respond to this kind of market. So they exaggerated the downturn of the market at some points in March of 2020. So I think it will take time for the machines to replace the humans. They might do at some point better job of course, investing, maybe selecting stocks because they take out the human nature of the process, but not replace totally humans out of the equation.
Now let's hear from Luis, who's the youngest of you all, okay? He's more up to the technology, okay? Luis, what do you think?
I'm probably younger, but I think in a more... No, I mean, let me keep it very simple because I very much agree with all the things that have been said here. For us, most of the times, good investment stories are not the ones that are very complex with a lot of variables where you need to compute a lot of correlations. But on the other side, good investment stories are probably simple with a few variables, but you need to understand them better than other people. These simple stories where some kind of either human or institutional biases is creating a market efficiency are the ones that we like and the ones where we think you can make money. It's not about looking at a lot of variables and a lot of correlations. It's just about picking a few and looking, and really being smart on getting them right.
Well, I think we're just about time finished. And so I'd like to thank you all so very much for this diversified, I guess, lineup of presentations touched at many different points. And wish you all the best.